Hey, today we're going to talk about net revenue retention, or NRR, sometimes referred to as net dollar retention, or NDR. And NRR is that percentage of recurring revenue that is retained from existing customers over a certain period, excluding any new business that you acquire. Okay, so this is after we account for all of our upgrades for current customers, downgrades for current customers, cross-sells for current customers, right? And all of the churn that occurs there, right? But we're not taking into account any new customer acquisition. That is NRR. And today I'm going to give you a brief presentation of what that is, what action steps we can apply based on understanding this concept, and how a RevOps organization inside of a company will actually use this concept and engineer a beneficial NRR for their team. So let's get into it now. So NRR is the most watched metric in subscription businesses because it captures whether that the existing customer base is growing on its own, if it's generating expansion revenue that exceeds churn, or if it's shrinking through cancellations and downgrades faster than expansions can offset that. And NRR is a metric that distinguishes great SaaS businesses from mediocre ones. So a company with an NRR above 120%, they have a customer base that is compounding before any new customers are acquired, which means that new acquisition is purely additive growth. So a company with NRR at 100% is treading water on existing book of business and depends entirely on new acquisition for growth. And a company with NRR below 100% is bleeding revenue from the existing base and has to acquire new customers just to stay flat. And the difference in business quality across these zones is enormous. And investors price SaaS companies or any recurring revenue companies largely based on where NRR sits. So let's look at our actual formula for NRR and see how this works. So NRR equals basically your starting monthly recurring revenue plus your expansion MRR minus your contraction MRR minus your churn MRR divided by your starting MRR. Okay, so what does that mean, right? Let's say that you have a starting MRR, your monthly recurring revenue is $10 million. Plus $2 million of expansion revenue. Now that's $12 million in MRR. Minus $300K of contraction MRR, meaning that current customers that downsold, minus $700K in customers that just left you in churn. That leaves you with 11 million overall, divided by 10 million. So 11 million divided by 10 million equals 110%, right? And basically all that means is you have your starting MRR, which is 10 million, plus your 2 million, that puts you at 12, right? And then you've lost through downsells or churn $1 million in revenue. Okay, so that 12 million compared to the million you lost puts you at 110%. Right, so starting MRR is the MRR from a cohort of customers at the beginning of the measurement period. Expansion MRR increases in subscription revenue from these same customers during that period. That's upgrades, additional seats, cross-sells, things like that. Contraction MRR decreases in subscription revenue from those same customers. So downgrades, seat reductions, things like that. And then finally, churn MRR, which is lost subscription revenue from cancellations among these same customers. Now, the key constraint is that NRR is calculated for an existing cohort of customers with no new customers added during this period. So this isolates the dynamics of the existing book of business, right? So here's an example. Let's say a company starts, like we've said, with that 10 million in MRR from existing customers. Now, what's important is how we define that time period. How do you define when expansion MRR is qualified? Typically, we do it over 12 months. So again, using our same example, over 12 months, let's say you go from 10 million to 12 million. Right. So you get 2 million in new expansion, let's say upgrades, upsells, cross-sells, and minus 300K in downsells, minus 700K in churn. Again, that's 11 million over 10 million gives you 110% NRR. And the one period NRR is a snapshot, but companies often report NRR on a trailing 12-month basis or by cohort over multiple time horizons because the trend matters, right? As much as the absolute number. So industry benchmarks for B2B SaaS are basically NRR over 130% is world-class. It's truly exceptional. If you're between 110 and 130%, it's excellent. NRR between 100 and 110% is obviously healthy. It means you're growing. NRR in the 95 to 100% is acceptable, but you have to watch it closely because it means it requires a persistent sales motion from you just to stay solvent over the long term. And then NRR under 95% is concerning, and the business may be structurally challenged for some reason. So NRR exists because the subscription business dynamics are fundamentally different from transactional business dynamics. And the most important question in a subscription business is whether the existing customer base is itself a growth engine or a leaking bucket. Okay. So in a transactional business, every single period's revenue really depends on every period's selling activity. So in a subscription business, the existing customer and that existing customer base produces revenue automatically every single period. That's why everybody tries to get into a recurring business model. And the question is whether that base is expanding or contracting. So NRR captures this dynamic precisely, right? It excludes new customer revenue, which is the responsibility of acquisition, and isolates whether the existing customers are net positive or net negative contributors to the revenue over time. So the components of NRR each tell their own story, right? That we've already defined. Expansion MRR captures the upside. Existing customers buy more seats, they're upgrading plans, they're adopting a healthy SaaS business, and the primary driver of NRR above 100%. And contraction MRR captures the downside that doesn't quite reach cancellation. So customers who scaled back their subscription, but didn't leave it entirely. And churn MRR captures the worst case, customers who left entirely. Now, a relationship between expansion and churn determines whether NRR is healthy. So a company can have high churn, but still produce strong NRR if expansion is higher. And a company can have low churn, but mediocre NRR if expansion's weak. And the two need to be evaluated together. The companies with the strongest NRR are the ones with both low churn, so they have good retention of the customer base, and high expansion, so they have existing customers buying more. Now, NRR is sometimes confused with gross revenue retention. Now, GRR, gross revenue retention, is similar, but it actually excludes expansion. So gross revenue retention captures only the loss side. So how much of the original revenue was retained, ignoring any expansion. And GRR has a maximum of 100% and is bounded above by definition. So NRR can exceed 100% and is unbounded because obviously you can expand as much as you want. And both metrics matter because GRR captures churn discipline. How many of your customers are actually staying with you versus churning? And NRR captures the full dynamic, which is the full revenue and profitability picture. And a sophisticated, let's say, SaaS analytics practice or business analytics practice reports on both. So the time period for NRR matters. Most companies report on a trailing 12-month basis, comparing that cohort of customers from 1 year ago to that same cohort today. Now, some companies report on shorter time horizons, for example, TTM by quarter or quarterly NRR, but shorter periods are noisier and less reflective of the underlying business dynamics. 12 months is that standard because it captures a full annual contract cycle for most subscription businesses. So let's get into an example. Let's say that you have a Series C SaaS company and is preparing for a board meeting. Their CEO wants to discuss whether to invest more aggressively in customer success and those expansion efforts or to focus on new logo acquisition. So the RevOps team pulls the NRR analysis, right? And the company, let's say, started 12 months ago with 24 million in MRR from existing customers. So over the past 12 months, those customers expanded by 5.4 million, so 22.5% of starting MRR, contracted by 720,000, 3% of NRR, and churned by, let's say, 1.9 million, which is 8% of ARR. So what that gives us is a net revenue retention of 111%, right? Because you have, ultimately what you have is 26.76 in existing revenue plus expansion revenue ultimately divided by 24 million, which is your starting point. So GRR for the same period would only be 24 million, which is your starting recurring revenue minus the 720K in downsells, minus the 2 million or the 1.9 million in churn, which gives you an NRR of 111% and a GRR of 89%. So here's the story. NRR is healthy at 111%, meaning the existing book grew by 11.5% on its own, but GRR at 89% reveals that the company is losing 11% of its revenue to churn and contraction every year, offset by strong expansion. So that expansion is doing the heavy lifting while the churn is concerning. And the team segments NRR by customer tier. So enterprise NRR is 135%, strong expansion, low churn, whereas mid-market NRR is 105%, moderate expansion, moderate churn, and SMB NRR is 88%, minimal expansion, high churn. And that blended NRR of 111.5%, that hides the dramatic difference across segments. And the team also analyzes the expansion drivers, and they find that 80% of expansions coming from existing seat additions in mid-market and enterprise customers, with very little contribution from cross-sell of new products. And this insight informs the strategic conversation. The business has a strong primary product, but underdeveloped cross-sell motion, and that the SMB segment has structural retention issues. So that board conversation, informed by that analysis, lands on a balanced strategy. They say, okay, continue investing in customer success at current levels for enterprise because it's working as designed, and invest more in customer success for SMB to stabilize retention, and build a dedicated cross-sell motion to develop that second product attach rate. Hold that new logo acquisition spend constant rather than increasing it because the existing customer base is producing strong returns, and the SMB retention issue needs to be solved before scaling up acquisition will be wise. So the strategic decision rests on the segmented NRR analysis, not the headline number. Okay. Now let's move into some myths about NRR and NDR. So myth number one, the most common myth about NRR is that higher is always better. And it is mostly, but with caveats, because a company with NRR of 150% achieved primarily through aggressive upselling of existing customers may be hitting the ceiling of their expansion potential and storing up a churn risk for future periods, right? If you sell a ton of your stuff and a ton of your offerings and you offer max all of your clients and all of your customers, they may, and you don't actually deliver that value across the board, then they may churn and realize you don't actually need this. We don't actually need all of these offers. We don't need to be paying all this money. And so a company with an NRR of 130% from broadly distributed expansion across many customers is sometimes structurally healthier, even though the headline is lower. So the composition of NRR matters as much as the level. Again, as with everything in RevOps, the key here is that we're trying to disaggregate all of these numbers, right? What you do is you disaggregate CAC, customer acquisition costs, into cost per channel, into CPA, so that you say, oh, okay, we have a CAC of $5,000. It's like, okay, but your cost per acquisition for events is $10,000 and your cost per acquisition for referrals is $400, but your referrals give you customers with a lifetime value that is, let's say, 20% of what your events get you, because your events are bringing you enterprise customers, but your enterprise customers have a CAC payback period of 5 years, and your referral customers have a CAC payback of 1 year. But that's only because the CAC is lower, right? So RevOps is about balancing the constellation of all of these metrics to then enable us to make wise decisions about where to allocate our resources. That's what RevOps really does, is it says, where is the channel? What are the driving levers that we can pull that can increase our overall revenue and profitability? And what we do is we have these high-level metrics, right? Like NRR, like CAC, like LTV, But those need to also be disaggregated so that we know within those top level KPIs what levers to pull to improve those. We already talked in another video about how once you disaggregate CAC into CPA to LTV, you give yourself the ability to actually identify how to maximize your spend and allocate your marketing spend so that you can have a lower CAC for the same amount of revenue or even higher revenue. And it's the same thing with NRR. Okay. It's that a company with, let's say, again, an NRR of 130 from broadly distributed expansion across many customers is structurally healthier. And so it's the composition of NRR that matters as much as the level across segment, the cohort composition. Okay. Small, medium business, mid-market, and enterprise. The second myth is that NRR can substitute for new logo acquisition as a growth strategy. It cannot, at least durably. So NRR above 100% means the existing book grows on its own. But the absolute size of that growth depends on the size of the base. So a company with 10 million in existing MRR and 130% NRR grows by 3 million in a year from existing customers. And a company with 10 million in existing MRR and 110% NRR grows by 10 million. Both are great, but neither one of those replaces the need to keep acquiring new logos to expand the future addressable expansion. So companies that lean too heavily on NRR and underinvest in acquisition end up with rapidly aging customer bases and slowing growth. So that's the second myth. The third myth is that NRR is comparable across SaaS business models, and it is not, at least not directly. So for example, a PLG business, which is a partner-led growth business where you're selling through other enterprise partners. A PLG business with a land and expand motion, which means you acquire the customer and then get most of your revenue, or rather you maximize most of their lifetime value through upsell rather than the initial acquisition. Those structurally produce higher NRR than let's say enterprise sales businesses that sell a large initial contract. Right? Multi-product platforms produce higher NRR than single product point solutions. And industries with high seat-based growth, like companies that hire aggressively, produce higher NRR than industries with a stable headcount. Comparing NRR across companies without normalizing for these structural factors produces misleading conclusions. The fourth myth is that NRR is a customer-centric metric. Sorry, a customer success metric, really. So that's the fourth myth, is that NRR is a customer success metric, right? Now, rather than a revenue operations metric. So NRR sits at the intersection of customer success, account management, product, and pricing. And the decisions that drive NRR live across all these functions. And treating NRR as a customer success scorecard misses the fact that pricing and packaging and a product roadmap and commercial motion all materially affect that metric. And the companies with the strongest NRR have organizational alignment across functions, with NRR as a shared metric rather than a CS-only KPI. And then finally, the deepest myth is that NRR captures the full economic reality of customer relationships. It does not. NRR measures revenue retention, but not gross profit retention, customer satisfaction, or strategic value. So a customer who renewed at the same dollar amount through aggressive discounting contributes the same NRR as a customer who renewed at full price. But the gross profit dynamics are very different. Again, achieving RevOps insights and actionable insights from revenue operations is all about disaggregating high-level KPIs, right? So again, that customer who renewed at the same dollar amount through that aggressive discounting contributes the same NRR as a customer who renewed at full price. But again, those gross profit dynamics are very different. NRR should be evaluated alongside gross margin trends against customer health scores and strategic value to produce a complete picture of customer base health. Now, how does RevOps apply all this? So for a RevOps team, NRR sits at the intersection of customer success, revenue analytics, and strategic planning. RevOps ensures NRR is calculated correctly, segmented usefully, contextualized appropriately, and used to drive decisions rather than just reported as a vanity number. And the data flow runs from, let's say, Stripe billing through Salesforce or HubSpot into Snowflake, transformed in dbt, surfaced in Looker, let's say with Gainsight running that customer-facing motion. And the first place RevOps Applies NRR is in the calculation methodology. So this calculation methodology is key. The team specifies that cohort definition, which of your customers really count and how the period is defined. And the component classification rules. So what counts as expansion versus new, what counts as contraction versus churn. And the time horizon. So the TTM is standard, but pick one and stick with it, basically. So document the specifics in your project management tool, codify them in your dbt models, and run Monte Carlo or Big I observability on the underlying tables. And RevOps owns the methodology and prevents that drift over time. The second way RevOps applies the NRR piece. So that first piece is really about just collecting your data and making sure that you have visibility and coverage and completeness in your data. The second piece is segmented analysis. So headline NRR is rarely actionable, okay? Segmented NRR or disaggregated NRR is. So RevOps builds analytical cuts in your business intelligence tool. For example, NRR by segment, by tenure cohort, by channel, by product, by region, by rep, right? Each cut surfaces a different aspect of customer base health and informs different operational decisions. So a segment with a declining NRR, let's say a drop of 5 to 10 points to a retention problem. And a cohort with declining NRR points to an aging customer base. A product with declining NRR points to a product market fit issue, right? Each way that you do a segment analysis points to a different issue that you have, right? It's not just about your headline NRR. A churn by product versus a churn by rep signal very different problems in your business to be solved. So the third way that RevOps applies NRR is through a driver analysis. So NRR, again, as we've been emphasizing, is an aggregate output, and the actionable work is really on the underlying drivers: gross retention rate, expansion rate, contraction rate, expansion velocity, time to expansion. Right? RevOps builds the driver decomposition in mode that explains NRR movements. Why did NRR drop from 115% to 108%? Was it churn, contraction, or expansion that changed? And within these, which cohorts or segments drove that change? So you could say, bring in product usage data or utilization that feeds the leading indicators, and the decomposition turns NRR from a scoreboard into a steering wheel. And then the fourth application is forecast planning. So the forecast planning is the NRR projections drive the forward-looking customer base growth that feeds that corporate financial forecast. So RevOps builds that model that projects NRR based on historical trajectory, customer mix, and operational initiatives, and then integrating it into the financial plan. The model informs decisions about customer success capacity, account management staffing, and expansion playbook investment, and expansion forecasting targets within 5 to 10% variance in 1 quarter out. So here are some insights we can extract. NRR data, properly segmented and analyzed, produces some of its most strategically valuable insights in a SaaS business. So the first is the cohort level NRR trajectory. So different customer cohorts acquired in different periods through different channels attributed via some business intelligence tool like Dream Data on different plans retain and expand differently. Some cohorts improve 15 to 25 points as they mature. Others decline 10 to 20 points. By tracking cohorts independently, you produce a quantified picture of which acquisition strategies produce customers who become long-term assets versus customers who deteriorate. And again, you can do this in Looker. You could do this in HubSpot. The second insight is the expansion pathway analysis. So customers expand through specific paths: more seats, plan upgrades, product additions, usage-based expansion. By tracking which paths are dominant in your business and which customers expand through which paths, you build the playbook that systematically drives expansion. So some companies discover that 70 to 80% of expansion comes from a single path. typically seat additions, for example, and recognize an underdeveloped cross-sell motion. And others discover expansion is broadly distributed in the right place to support all paths equally. The third insight is the churn taxonomy and prevention pattern. So by classifying churn, let's say in your CRM, into categories like involuntary, voluntary product fit, voluntary pricing, voluntary competition, voluntary business closure, and analyzing each pattern, let's say in a tool like Looker, you identify which churn is preventable and how. So typically 50 to 65% of voluntary churn is addressable through customer success interventions. And the unpreventable subset informs decisions about ICP focus and customer selection. Without this taxonomy, churn looks like a single number. And with it, churn becomes a structured improvement backlog. Now, the fourth insight is segment-level NRR variance and what it reveals about the business model. So SMB-heavy businesses typically run an NRR of 85 to 100%, while enterprise-heavy businesses run 110 to 140%. Product-led businesses produce different exposition or rather expansion patterns than sales-led businesses. So by analyzing the segment-level variance, let's say again in Looker, and comparing it to the company's go-to-market strategy, you identify whether the strategy and the customer base are well matched or whether the company's investing in segments where its model produces structurally weaker NRR. And finally, the fifth insight is that relationship between commercial decisions and NRR outcomes. So pricing changes, packaging changes, contract term changes, and discount practices all affect NRR over time. By analyzing the NRR impact of past commercial decisions against billing data from Stripe billing, you build that institutional knowledge about which commercial moves produce sustained value versus short-term gain at long-term cost. This insight is valuable when evaluating proposed pricing or packaging changes prospectively. First, you want to formalize the NRR calculation methodology. So specify the cohort definition, the component classification rules, and the time horizon in your master document for calculating NRR. So you want to codify that logic in your database models, get sign-off from finance and customer success, and ensure that every single NRR ever reported uses the same approach. And write the methodology document, drive the alignment conversation, and prevent ad hoc methodology drift. Second, build the segmented NRR analysis we've been talking about. So calculate NRR by segment, by tenure cohort, by channel, by product, by region, and by rep in your Snowflake dbt, and build a dashboard in Looker that surfaces all the cuts in a single view. So scope the dashboard, build it on warehouse models, and integrate it into the customer success and revenue leadership operating rhythm so that NRR is never discussed without segmentation. Third, build the driver decomposition layer in mode. So when NRR moves, the team should be able to explain that move by component. So expansion versus contraction versus churn. They should be able to explain why NRR moves by segments. So which segments drove the change? SMBs, mid-market, or enterprise. And they should be able to explain NRR moves by cause. So specific accounts, events from Salesforce or HubSpot, pricing changes from Stripe billing, product usage signals from Pendo, things like that. And you want to build the decomposition model, surface it whenever NRR changes by more than 3 to 5 points, and use it to drive targeted operational responses. Fourth, wire NRR into your operating rhythm. So customer success reviews in Gainsight, revenue leadership meetings, and board reporting all reference NRR in its segmented and driver decomposed forms. So NRR forecast is a line item in the financial plan in Pigment. So NRR affecting decisions such as pricing changes, packaging changes, customer success investment are evaluated against expected NRR impact. Integrate NRR into the operating cadence of your company rather than letting it be a quarterly board metric that nobody actually reports on or looks at. And then fifth, build the expansion playbook informed by your NRR analysis. So identify the expansion paths that produce the most NRR contribution, the customer profiles most likely to expand through each path, and the operational triggers. Again, use utilization metrics, product usage metrics, lifecycle milestones, intent signals, and all of these things that prompt successful expansion conversations. So equip the front line via via HubSpot or any other tool that you can to actually execute this vision and measure NRR improvement attribution to the playbook adoption. So target 3 to 5 point lifts in 2 to 3 quarters to improve your NRR. And without this final step, NRR remains a metric that the company watches rather than a metric that the company actually drives. So this is, again, probably the single most important SaaS metric because it determines, are you growing or are you dying? And again, net revenue retention is called net dollar retention sometimes, or NDR, and it's the percentage of recurring revenue retained from existing customers over a period after accounting for upgrades, cross-sells, downgrades, and churn, but excluding any new customer acquisition. So thanks so much for tuning in today, and we look forward to delivering you more content explaining some of the core concepts in RevOps coming forward. Thanks.